Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. Scott Hansen.
Pat McClain, thanks for joining us.
Yep, we'll talk about financial matters today and a little bit about the markets. Of course, take your calls. And our objective on this program, like every other, is to help you make wise choices with your finances. We believe that the more knowledge somebody has, the better choices they're going to make and the more confidence they'll have with their finances. Because studies have shown that wealth and confidence in your finances are not necessarily correlated.
Yes.
So you've certainly seen plenty of people that have a lot of money and are freaked out about the economic future, and you see other people that have more modest means and have complete confidence in their future.
I talked to an 89-year-old client earlier this week that was exactly as you described.
Which one, the first or second?
I don't remember in what order they came, but he was doubting his portfolio for a little bit, and it's an interesting thing.
And how long has the client been with you?
30 years, Scott, and we go through this every 18 months.
Pat and I started in the industry in 1990. You still have a handful of clients.
I do.
Yeah. I don't have any clients any longer. Still there for them if they need to reach out, but there's other certified financial planners I work with. But you still maintain a handful of.
And I love the interaction, but it's every 18 months, and it normally.
And after 30 years, there's not a lot of planning to do, my guess.
And his grandkids won't spend this money. His great grandkids won't spend this money, but
they might.
Okay, well, that's
the grandkids will.
But it normally has to do around political events. And he has a tendency when he gets wrapped up in this little thing is to actually look at the negative of every side of the picture, which is the emotion.
Those are all the
coming
news
out.
Stories.
Yes, it's all news stories. Or there'll be a little, he sent me an article about the debt in the U.S. and how it's going to sink all the markets, stock markets, bond markets. And I said, well, the debt's real, but unfortunately the country has enough wealth that it can overcome the debt problem with legislation. That's real.
There's more assets than there is debt.
That's, yeah.
The federal, frankly, there's more assets with the federal government too.
Yes.
And the power they have.
That's right. That's why. But it's interesting. The confidence, it every 18 months, we go through this little exercise. And I think back of all those times that he wanted to get out of the market and didn't. Because getting out of the market is obviously the easiest thing to do.
Right. It's getting back in.
Yes. When do you get back in?
And it's really hard. I mean, I think of times, Pat, when I've had clients. I think back to the the Great Recession. And this is a client. He'd been a client, I don't know, 5 or 6 years prior, maybe longer than that, and I think about before the financial crisis. The market started selling off a bit in 2008. Actually, I think the latter part of the 2007. 2008, Scott, I think we should get out of the market. Call. Well, no, here's why I don't think we should, and lay out the whole thing. 3 months later, markets are lower. Call. Scott, I think we should get out of the market. And mind you, he wasn't 100% in stocks. Like, our approach is never 100% in stocks. It's always making sure people have some liquidity available to them if they have some capital needs and income needs, that sort of thing. A few months later, now we're in beginning of 2009. I think January. Talked to him again. Markets are lower. So now I'm looking like an idiot because he's thinking I should have not listened to Scott the first time. I talk him out of it. Then he calls the first part of March, chooses not to speak to me, finds somebody just kind of in our trading department.
Okay.
And places his own orders to get, or did it online. I don't know how he did it. Anyway, without talking with me about it, and got out of the markets entirely. This was like 4 days before the bottom.
The bottom is a contraindicator.
And the reason I'm bringing this up, the challenge is when the market started recovering, he'd say, "What do you think, Scott? Should we get back in?" And I honestly didn't know what to tell him. I said, "I don't know, because I didn't tell you to get out. But you got out. because it spooked you. So the concern is we get back in, the markets have a little brief period of sell-off, and you've just hit a double whammy. Now you're going to incur more losses.
Did he get out of both his stock and bond positions? This whole thing went to cash?
I think he kept some of his fixed income positions.
Okay.
I don't recall.
But the reality is, Scott, I gotta tell you, I've been listening to a ton of podcasts about AI, right?
Yeah.
And
because it's easier to listen than to learn the tools.
Well,
Not kidding. I actually do use some of the tools.
I do use a few of them, but the thing I find two interesting things is the business models of the companies are changing greatly from a variable spend, the software companies, to a capital spends, right?
A tremendous amount of capital.
Right, tremendous amount. And the other is the capital spend, although they come out with these big, bold announcements, my guess is about 60 to 70% won't take place because of technology actually becoming more developed and not having to use as much energy and as large a space for the chips themselves.
Well, you listen to some, they say, maybe in 5 years we don't need nearly the amount of energy that we need today.
That's right. And the other thing that is that there'll be a fight between the AI companies and the businesses that use the tools over cost, because the break even is, if I'm using an AI agent, what's that AI agent cost relative to an employee?
As in every technology spend.
That's right.
Do I put in the self-checkout at the supermarket, or do I hire somebody?
And how many customers am I going to lose that won't do the self-checkout, or what is my shrinkage by theft? It's interesting to talk about it. It's interesting to watch. I think that profitability of firms over the next 5 years will, quite frankly, will just amaze some of us. But I think it's a societal problem that needs to be dealt with.
It is the most interesting time with all this AI, right? Because, for myself, there's part of me that's really excited. This is really pretty cool. I'm alive watching this transformation. The other part is are we creating our own demise? Right?
Yes.
And you think back to the Terminator, this doesn't seem that far off.
It doesn't. And even I find myself using AI for things I used to plug into my calculator by hand. Net present value calculations.
I had a home that I had bought and sold, and rather than running I just put it in ChatGPT, and I think I dictated it all. I paid such and such, and I got this much rent, and I just wanted a kind of a ballpark what the ROI was on it.
It's crazy. It's crazy.
Well, it's an interesting.
But back to the confidence. You can view the world a lot of different ways, right? You can view it through a positive lens. You can through a negative lens. I think especially hard now is depending on what side of the aisle you are politically. You have a view of the economy that's actually shaped by that.
Well, you have to. If the other side's the enemy, which is kind of where we are today, there's very little centrist. It used to be you could vote for the person, not the party. But if you don't vote, in Congress they don't vote the party line, they're done.
Yes, it's over.
I mean, look what Trump just comes after people we're going to primary you to death. And anyway, we don't want to talk about politics. What I did want to mention before we take calls. Oh, and by the way, if you've been most of you who are listening to this right now, this isn't your first time listening to Allworth's Money Matters with Scott Hansen, Pat McLean. You've listened to this in the past. If you find this helpful, beneficial, think of 2 or 3 people in your lives that could benefit from this and forward it on to them. Just say, this program's been helpful for me. I think it'll be helpful for you. We would appreciate it if you did that for us. All right. Before we take the calls here, Pat, I saw a chart the other day on global stocks. So owning stocks outside of the U.S. We've been in this industry long enough to see these trends, right? So there was for a while, it was have a lot of global stocks because the global markets were a good place to be. Then it was don't have them in global markets. And frankly, the last decade, really since the financial crisis, it's been challenging to own international stocks because compared to the U.S. markets, they have lagged.
Because there's 2 components to it, right?
One is their overall returns, and the economies have not, for the most part, haven't done as well as the U.S. Secondly, it's the change in
Their currency to the dollar.
Yeah, when you have a strong dollar and you own foreign currency, it's not helpful for you. Well, this last year, foreign markets performed well, by and large, and the dollar fell. So you've got kind of
double whammy.
Yeah, got two kickers there. And a lot of the foreign markets up 30% or more. Well, when you look at flows, that's what's so funny.
And describe flows.
Where money into ETFs, exchange traded funds. And so these are not only, they could be individual investors, they could also be money that's directed by advisors. I don't know, the article didn't break these down. This just happens to be money flowing into foreign stocks. And you look in 2004, we had a couple quarters where we had negative flows. People are pulling money out of the U.S. International stocks, presumably to go back into U.S. So they're
2004, so 22 years ago.
I'm sorry, 2024.
Okay,
thank you for correcting me.
Thank
I wonder
you.
why you quit. Yeah, so just a year and a half ago, they're pulling money out. So last year, the market was on fire. And we look as the year went on, more and more money's flowing to the foreign markets. So you look at December of last year, it's just off the charts. And I'm thinking, why is it that in the investment markets are the only markets that I know of where people want to buy more when they're expensive? When prices go up, people want more. When prices go down, people want less.
It's because people, I hear it all the time, it's doing well. It's not doing anything. It did well. The mere fact that we can measure it means it's over.
It's all history.
All of it's history. All of it's. But remember, we had the same thing between growth and value stocks for years. And the flows just.
I mean, I think of my own portfolio because I have an allocation to international stocks. And I remember over the years, it's been like, wow, this is kind of hard to own when the S&P's up 15 and those are up 8 or whatever the numbers are. Well, it was quite a nice year last year.
It helps.
It helps a lot.
Yeah, but that's just part of a global, a well-balanced portfolio is to own international stocks in it.
Well, and to your point, if you're highly diversified, at any point in time, you're going to have something that's not performing well.
Oh, you're going to be unhappy. It's a bad portfolio if you're not unhappy with 20% of it. 20% of your portfolio at any one point in time, if you're well-diversified, you should be looking at it. But the problem is it's always a different 20%. You should always be looking at your portfolio and thinking, God, a fifth of this thing isn't, I should get rid of it. But in a well-diversified portfolio.
There's another 20% slug that is crushing.
Yes.
Right? I mean, that's usually how it works. Like, wow, look at these stocks. These guys are going gangbusters.
But don't be tempted to move that direction.
Yeah. All right, let's take some calls. If you would like to join us and be a guest on our program, we love taking calls, having guests. Send us an email at questions@moneymatters.com. We're in North Carolina talking with Chris. Chris, you're with Allworth Money Matters.
I appreciate you guys taking the call. Thank you.
Yeah.
Hope you guys are doing well.
Yes, fantastic. Thank you.
So over the last 2-ish years, I've kind of been on this called DIY, educational, in personal finance, and been helping piece together my wife's and I's kind of retirement journey to roadmap to follow. And I've got 2 questions on what I'm going to call our old life. We met roughly 10 years ago in the Bay Area. Fast forward to now, we're in North Carolina. I've been there for roughly 7 years. And my first question, and kind of skews more towards my wife, but the home that she was in when we met, we've been renting out for the last 7 years. It's kind of this unicorn scenario with family where her family's helping kind of be the landlord, take care of lists, like haven't missed a day of rent, but the cash flow on this thing sucks.
Who are you renting it to a family member, or they're just helping facilitate it?
They're helping facilitate.
Okay.
And so, but yeah, otherwise the cash flow is not great. And we know it's not in the long-term plans. And I guess in the broader scheme of where we are with, retirement savings, et cetera, there's like this level, like, I've heard you guys talk several times about, like, I think, and just kind of being done with rentals in the past, but it's like there's a level of like easy button. Would love to just sell this thing, take the hit, not do a 1031 exchange, and throw it to a brokerage and let it ride for the next 20, 30 years until we're ready to tap into it.
What's the value of the house?
Rentals roughly 900. We owe 475 on it. Got one of those primo COVID interest rates of 3.5. So,
What did she pay for the house?
Originally it was like just over 5, and that was back in 2016. There's a refinance in 2021.
And how much income does it generate net after expenses, everything? And that includes the new water heater, the gutters on the home.
And it actually should include some sort of sinking fund for capital expenditures, like when the roof needs to be replaced.
So annually, we're at like a 3,500 net, which is basically 1 month's rent.
Okay, 3,500 net. Okay. Well, obviously that is a terrible cash flow. Yeah, but we're going to talk about a Delaware statutory trust here in a second. Explain what an option is for this.
Yeah, that's where it's like, because really where I'm at is like I want to make sure I'm seeing the forest for the trees, because it's like there's this level of like easy button. Let's just be done with this. Throw it into a brokerage, because I think in the broader context of like where I'm at with 401k savings, I think we've kind of got the room to kind of just do this and be done with it and set at least a portion of things on autopilot. But so cash flow, $3,500 a month, or excuse me, that'd be nice. $3,500 for the year. But
is this rented out to family members
it's
or
not,
friends?
No, but the family members are involved in managing it somehow.
Correct. Yeah. So that's been the easy
just to test the relationship.
Oh, of course.
Are they getting any economic benefit as a result?
None. It's a unicorn scenario. There's no fees or anything. It's out of the goodwill of their heart.
So, Chris, before we go on, how old are you?
I'm 35.
Oh, okay. And how old is your spouse?
37.
And do either of you have children from a previous relationship?
We do not.
Okay. All right.
We got a little 2-year-old. So.
Oh, congrats. Okay. And you own your home in North Carolina, I'm assuming.
Correct.
And what's the mortgage balance on that house?
We're $325.
What's it worth?
Also $900.
Okay.
What's just out of curiosity, and I don't know where in North Carolina you are, but set a picture of what the house is like in the Bay Area for $900. These are equal priced homes. What's the house like in the Bay Area, and what's the house like you're living in North Carolina?
I see where you guys are going with this. North Carolina is purgatory for whoever's listening. It's so hot. Homes are much smaller than the Bay Area.
Okay.
Don't come. Don't come here.
Don't come. Keep that pipeline to Colorado and Texas alive. But no, we're in the suburb of Charlotte. Literally just right outside of Charlotte. And it's I think we're like 3,700 square feet. Home, and it's so much of this is timing. We bought 2020 and have just rode the wave of equity up.
So here are your options with the rental. One is you can just ignore it. Keep it as it is and hope for the best long term, right? Which is what you've done the last several years. Secondly, is you can just sell it, bite the bullet, pay capital gain taxes, of which you're going to incur its 20% federal capital gains tax rate, plus state of California, because it's in California, you'll end up with 10 point something percent or so on capital gains for California. And then you're going to bump up to also to the Obamacare tax, the 3.8%. So
you mentioned a refinance. Did you take money out of this property?
Yeah, we did pay her father back her parents back for helping buy. So yeah,
worked out good.
Yep.
So and the third option. Well, you have 4 options. The third option is to sell this and maybe buy 2 rentals in around where you are, You can do that. You can do 1031 exchange. You can't. You got to essentially keep the same loan balance and the same kind of equity balance. So if you either reduce your indebtedness or the value is less, it becomes a taxable event, taxable boot they call it. And then the fourth option is to do what's called a 1031 exchange, tax-free exchange, into what's known as a Delaware Statutory Trust, DST. And these are, and they've been around for years. Think of them as partnerships that tend to be commercial type endeavors. So maybe it's senior housing, or it's apartment buildings, or it's commercial, or whatever. It could be a variety of different things. But you can exchange this into, and this, you've got about a 50% debt rate. So you'd have to find other properties that had similar debt or more in order to be a completely tax-free event. But if you structure it properly, you could exchange it into that. And I forget if it's 721, there's another rule, that if it's structured properly, those can be converted into the securities of the real estate investment trust that manages these properties. So you end up diversifying away from a single property, or you could do a couple properties in this situation, into the REIT itself, and then you can sell portions of it at a time and incur capital gains, spread the capital gains over a period of time.
And Scott, would you, because of the indebtedness on this and the amount and his age, is it worth the hassle?
I did one for myself. I took a residential rental and converted it into senior housing.
Did you have
senior living?
You didn't have debt on it, though.
No, but I chose to have a property that had some debt on it to basically increase the risk exposure. I mean, myself personally, that's what I wanted to do at the time. To your point, and the challenge with doing that, it's not like the universe of investments are open to you. There's a handful of companies that are sponsors in these Delaware statutory trusts, and your limits are what properties, what syndications are open currently.
And not only what syndications, which ones are worth investing in.
Right.
Because there's lots of real estate syndications that are garbage.
That's correct. And so you could end up exchanging something that has a poor rate of return the next. But then I also look at, the stock market's what would you do?
I'm just thinking I would.
Those are your options.
Those are the options. I wouldn't mess with the Delaware Statutory Trust. He's 37. His wife's 35. He's got a 2-year-old at home. I assume you're employed.
Yep. Employed. It's sort of like there's a level of. I haven't heard of the Delaware Statutory Trust, but I'm going to look it up. But it's like there's a level of like easy button, and there's like, nobody enjoys paying taxes, but it's like there's a level of like, why don't we just eat the taxes now? I was assuming maybe 300 would we would take to the bank, and otherwise put in a brokerage and let it ride.
That sounds about right. That sounds about right. Three and a quarter. Yeah, that sounds about right.
And so that's where I was like that, and I think in the context of our broader puzzle, it's like I think we're okay with that, but it's like I wanted to make sure we're
and it could be not just the brokerage, but maybe you look at, all right, we figure out what the 529 should be funded at for the 2-year-old, right? Those sort of things.
Yeah, I feel like with each year my Grinch heart grows a little bit, but
your Grinch.
My Grinch heart is growing each year with
what does that mean?
I think my wife and I grew up very differently, and I had to pay for school, and you can go down the list, and there's very much a yin to the yang, and so right now where we are with 529 is like when baby number one right now has got 30,000 in it, and the goal would be just to kind of, it's in a total market fund, and just grow that to, and then once baby number 2 pops out, that will put another 30,000 in and let it go.
What's the overall net worth investable assets? Not including the home.
Not including the home
or the rental.
My 401k Roths. Brokerage. Just pure retirement. We're at 500, and got about 50, 55 in a brokerage right now.
And what is the family income?
So it's just me right now, but I'm anywhere between 160 and 175.
I would hit the easy button.
I think you're doing well.
Oh yeah, he's doing very well.
Given the income level and what you've got saved in your
Yes.
assets, I think you're doing great.
I wouldn't mess with the Delaware statutory
I
trust
think
on
you're
this.
You have what you're so limited, and it'd be such a big chunk of your net worth. And if it didn't work, yeah, I agree with Pat. I don't think I would bother either.
I would just
Yeah,
take
that's,
the
that's
tax.
where it's like as I've been piecing stuff together, it's like, oh, actually, I feel like I was we were blindly doing, the quote unquote right things to do, and started trying to piece some stuff together, and it's like, okay, yeah, I think we're actually ahead, and there's a level of like, what can we do to just make it easier now? So.
Oh, that is look. The easier it is, first of all, to manage the assets, the easier it is on the relationship between you and your spouse. Number one.
Oh yes.
Right. I know. I'm married to an accountant. And I actually had to say to my wife the other day, let's not let this financial thing get in the way of our relationship, because we were discussing a financial situation.
Well, look, and Pat and I have done some investments over the years together. And the reality is, some investments are home runs. Those are ones that your friends talk about at the cocktail parties.
Yep.
And some don't work out so well.
Well, that's just the nature.
So I could think of the one or two that Pat and I have done over the years that maybe didn't crush it.
And I could think of a half dozen that did great.
And sometimes some of these things, they're almost impossible to ever get out of.
That's what scares me about a Delaware statutory trust.
Yeah.
I mean, sometimes it's just there's the liquidity, and they just continue on for years and years. Then you get these K1s that go for years and years.
Now, I'd sell the house and go there. And any other questions for us?
Yeah, I got one more. So this one, I feel like I'm gonna think I think I know what you guys are gonna recommend. But so the second part of our quote unquote old life, she was a teacher in California, had vested in I forgot what it's called, but the otherwise she's 5 years in and
State Teachers
yep.
Retirement System.
And so the math on that works out to like $7,000 a year, but that's 25 years from now. And I feel like I got bored and cost of living adjusted it, and it's like $2,500 of today's money.
And what's the net present value? What's the
that's a big assumption.
Yeah.
That there's going to continue to have a COLA on it.
What's the lump sum today?
31.
Well, the numbers, let's just go by the numbers.
Because I think the maximum cost of living adjustment on a CalSTRS is 2% a year. I could be wrong, but I think that my recollection is correct.
Yeah, but it's $7,000, and the $7,000 gets paid out at age 55 or 60.
Correct.
Or 65.
What's the number?
That's what is it, 2% versus your last 3 salaries times the years of service. That number is 7,000.
Yeah, but is that at age 65?
I'm gonna need to double check, but
Yeah.
I'm assuming
You got to run the numbers.
Yeah, but I would not leave my money in. We're looking at, she's 37. We're looking at a 23.
Well, if you still lived in California, it'd be different. Because then we might say at age 55 she should go back for 3 more years and pension spike.
Bump it. Yeah.
Yeah, that's where I was like, yeah, if we were going to come back, I think it would be a very different conversation. But at least as of now, there's no plans to do it. But it was like we were looking at just taking it out, and it's like I feel like the account, when we were bumping doing the numbers, it was, where did it go in here? It was going to grow to otherwise a couple $100,000, and it was just like it would it was ultimately there are options, but it was like it didn't really feel like I don't know if we need to do anything, but yeah.
Well, you can defer the decision. But you have to go through the numbers, and what you're trying to figure out is what the rate of return will be in order to provide that.
Well, it's probably the same hurdle rate that they use internally, which is either 8.25 or 7.75, somewhere in there. You can go on their website, and you can just Google and figure out what's their assumption on their pension.
Yes, but then the second risk is what is the likelihood that actually is going to come true?
What comes true?
that they'll be able to pay that pension. I mean, we're talking 23 years in the future.
Out of California.
In the state
They're
of
not
California.
exactly flush with
which not the STRS pension, but the PERS pension. The estimates is that it could be
$1 trillion.
$1 trillion underfunded.
And STRS is grossly underfunded as well.
Every bit as much. Or at least last time I looked at it was.
They just keep kicking the can down the road.
What would you do?
I take the money out.
I take the money out.
And put it into an IRA and invest it for a 30-year portfolio.
Yeah. And the return might not be as much, but you don't have any liquidity risk on it at that point in time. You can always, at least under the current rules, you can buy back your pension if you move back to the state of California.
Yep.
Actually, did I tell the story about how I had that lady come back to work for one day in
let's
order
have
to
that
spike her
story.
pension?
Hey, Chris, we good talking to you. Wish you well. And sounds like you are well on your way to
impressive,
financial
actually.
security.
Quite impressive.
Yeah, so I remember the story. I've told the story.
Oh, I had clients that came in and
look, here's the deal. We work on behalf of our clients, right?
Naturally.
We have a fiduciary interest to act in our clients' best interest, which means we give advice to our clients that are in their best interest. Sometimes these are not in society's best interest or the broad taxpayer's best. But look at
the taxpayer
politicians
create
they create the tax structure, they create the pension schemes, all that stuff. They create the rules. Just like when you sit down and play a game, what are the rules of the game? Okay, these are the rules. You understand the rules of the game and you play within the rules. That's what this is. So
when you look at pensions, if people separate from service, especially in governments or even in large corporations, they will actually you vest your pension, so you can leave in an unvested pension. But if you come back, depending upon your age and your length of service, you can vest your pension.
Yeah, so typically, it's to vest a pension, it's a combination of years of service and age, and it benefits the older. So some might be, hey, if you're 60 or older and have 10 years, you're vested pension. You're vested for a pension. Let me rephrase it. But it might be that you have to be there until at least age 55 or age 60 to have any sort of vesting. So you might have 30 years, but you might not be vested because of the age.
But I've done it with people that worked in government and utilities.
Yeah, private sector as well with pension plans.
Yes.
Yeah, so give us the story.
She came back. And
I know who you're talking about.
She came back. I was just meeting with them, and I said
she had worked for the government.
And then she left when she had children.
Yeah.
And then at this point in time, she was 55. And I was meeting with him, and I said, if you went and worked one day, you would turn your unvested pension into a vested pension and get health insurance for life.
And this is how it was structured that day. It was only a day. You didn't have to work 3 months or a year
just
or whatever, 5 years.
Just one day. And I said, so...
Lifetime medical.
Lifetime medical. Just unbelievable. And then all of a sudden your pension goes from, a lump sum of $80,000 to $1,500 a month. And I said, just go back and work one day. And so she went back and got a job at the state. And I said, it doesn't really even matter what it is. The higher the pay, the better. But it's based upon.
Did she literally work for one day?
She ended there 9 months.
Oh, really? 9 months?
Yeah.
At a big tearful retirement party.
It was sad. They were all sad to see her leave. But if you've left it's real. Especially in utilities.
And if you calculated what her pay was during that 9 months, massive. Because before she probably had a small deferred vested pension, probably something similar to this. At age 65, would pay her a few grand a year.
Yeah.
She turned that into a monthly pension, whatever the dollar amount was, and lifetime medical.
And even if you take a deferred vested pension into an IRA and roll it out, you oftentimes can buy back that pension in this situation. Even though you took the money from the organization that you left, you can buy back the pension.
And it's all every pension plan's unique, and it's all the
yes.
So. It's essentially,
which is actually why pensions these defined benefit pensions have pretty much gone by the wayside,
except for government
and some utilities. Yes,
just because the
risk stays on the company.
Yes, and people game the system.
Yeah.
Right?
Yeah.
You become fire chief for your last year so you can get a good pension, and then you tap your buddy on the shoulder, they're fire chief. Then you tap your next buddy on the shoulder, they're fire chief. I'm not picking out firefighters, by the way.
Got to grow a mustache.
Or fire chief.
So the fire chiefs don't have mustaches, do they?
I don't know.
Or just a fireman.
I don't know. Is that a requirement? If you become chief, you shave it?
Yeah, I think so. But if you're fireman,
We sound like we're mocking firefighters. We don't mean to mock firefighters. Look, I don't blame anybody. Again, these are
the rules. How many times have you helped people do this?
We try to plan our taxes so that we pay as little as taxes. We try to avoid the IRMA tax if we're over 65 and on Medicare. Like, we do lots of things to try to maximize our own economic benefit, and sometimes to the cost of the government not receiving as much. It's the same. I think these are the rules. Well, they created the rules and agreed to the rules.
I think this is historical. What's good for the individual is not necessarily good for the whole, and the inverse is true as well.
Yeah. Anyway, if you find yourself in any situation like that, talk to a good advisor who's dealt with those.
Absolutely.
And spend some time with the retirement department.
Yeah.
I remember I had a friend that was a. Is he still doing this? Maybe he's still doing it. So I shouldn't say. I'm not going to mention it. Okay. I can't mention it.
All right.
It's not good, though.
Let's go to the next call.
Taxpayers.
It's not.
Just some of the government waste stuff. All right. Let's talk to Glenn in Ohio. Glenn, you're with Allworth's Money Matters.
Hi, guys. Thanks for taking my call.
Yeah, glad you joined us.
Yeah. First of all, I just want to tell you, I really appreciate your guys' podcast. I've probably been listening 3 years now and get a lot out of it.
Well, thank you.
Cool.
Yeah, you're welcome. Especially like your banter between the two of you. So keep that up. But all right. So
they don't enjoy it at home nearly as much. As my wife said to a friend the other day, don't encourage the behavior.
Your behavior?
Yes.
Yeah. Well,
I get the same thing. So you're not alone on that one.
Thank you.
You're welcome. But anyhow, I actually, hopefully you're going to let me ask two questions, and they're both follow-ups to what you guys have given out as advice in the past. So just let me start off with one. I think it'll be a quick answer. And first of all, I'm widowed and then married again, and both my wife and I have children. I guess the term is spendthrift, but people, and it's really their spouse that we really don't want to give them the money in a full lump sum.
Yep.
So again, and I just listened. I actually was listening to your talk show a couple weeks ago, and you guys were talking to somebody, and you recommended trust. But my problem is, and this is a different talk show, I heard that somebody said that trusts are taxed at a much higher rate. So if your trust is set up to hold that money for the 20 years that you want to distribute it, is it not true that money that when you first die and whatever you call that, when you first put it in there, it gets taxed at a much higher tax rate than what our kids would be taxed? Is that true or not?
Kind of. Kind of. Do you want to explain what the difference between a revocable?
What you're like, a lot of us have living trusts set up, right? They're called irrevocable living trusts. We set them up for probate purposes. We can revoke them. We can revoke them at any time. I changed my mind.
Excuse me. You said we have irrevocable trust.
I'm sorry.
It's revocable.
Twice I've misspoken today. Revocable living trusts. Many of us have revocable living trusts. We can change the beneficiaries anytime we want. We can take something out of that. We can dissolve the trust. It's revocable. We have power over it.
It stays in our estate. That's key.
It stays in our estate.
It stays in our estate.
Irrevocable trust is where we transfer some of our assets into a trust which we typically no longer have control over. And it's designed for two purposes. One, to get it out of our out of our estate. And secondly, and it depends on someone's estate. If someone's got a more modest estate, they may want to maintain some control, but the fact is it's still irrevocable. In an irrevocable trust, on any income that the trust earns, interest, dividends, capital gains, etc., the graduated tax rates occur really quickly, right? So for most of us, we don't get to the top tax brackets until $600,000-$700,000 or whatnot. With trust, it's something like 10 grand or 20 grand. It's you're pretty much taxed at the top tax rate from day one. That's for money. $16,000. That's for money that remains in the trust. If the trust pays out distributions to the beneficiaries, then there's no income that's left within the trust to be taxed at these punitive rates, and the income that was distributed to the beneficiaries is taxed based upon the beneficiary's tax structure.
So The answer to the question that you said is yes and no. It depends on how the income is distributed out of the trust. So So describe your situation, and we'll give you what we think is the best way to deal with it. So if you have a spendthrift child, you give them a lump sum, or their spouse, and you give them a lump sum.
They buy a Lamborghini,
right? And I've seen it. Not a Lamborghini, but a house on the beach. What are you trying to achieve? You want this money
what we were hoping to do for both of them is actually somehow create a 20-year payout of, again, if assuming it's going to be over 500,000, could be $1 million by the time we die. But in any case, each one we would just somehow pay that over 20 years. And and my understanding is, again, just like you said, if the trust holds it, then it is taxed. That money that went in there and whatever it's holding on to the next year, they're taxed at. So somebody suggested if we put them, again, the trust and the trust directions or directives or whatever you call that are to create a 20-year annuity. Is that actually considered giving them the money?
No.
Not until you can set up a trust. So my assumption is this is what you want created upon your death. Is that correct?
Yes, that's correct.
Yeah. You could structure it, say, upon my death, I want 500,000, whatever the dollar amount is, to buy a 20-year commercial annuity to have these dollars paid out on a monthly basis, annual basis, over the next 20 years. That's clearly something you could do. And if you say, well, I don't want to have it 100% in fixed income, you could actually buy what's called a variable immediate annuity. It's quite complicated, but they when you have something like that, it invests in equities, and then the payout fluctuates each year based upon how the equities perform.
So they take a number of units, they purchase the units. Let's say they purchase 240 units. In that particular trust, they pay out 1 unit every month for the next 20 years.
And the units can be different.
The units will fluctuate up and down based upon the underlying portfolio. If you were in my office, I would say you have that choice, or you can actually put restrictions in the trust. We can hire a third-party administrator who acts as a fiduciary. There's both a fiduciary and then an administrator of the trust. I would say for $500,000, I would just buy a commercial annuity, variable annuity, and I'd lay out a portfolio that was 60-40.
Because the administrative costs
will eat up a lot of the return.
Look, the reality is when you're no longer around to negotiate fees, right, and it's an irrevocable trust, you're not getting just my experience, like the fees aren't cheap typically.
Yes.
So to administer that, you've got to have, to your point, Pat, you have to have an administrator. You've got to file a tax return.
It's a lot of work. That's why if you buy an immediate annuity,
if you had $5 million, you'd say, "We'll set up the trust."
But by buying an immediate annuity, there's no tax returns because you've contractually turned that lump sum into a stream of payments, and the income would be paid by the beneficiaries.
Okay, that's what I was hoping. Okay, that makes sense to me.
Is that right, Scott?
All right.
I don't know what you meant by the income is paid to the.
Well, the principal isn't. There's no tax on that,
correct.
But any of the income,
any gain on that,
it would be paid by the beneficiary. The tax.
That's correct.
Yes.
Yeah, 100%. Because it'd be their country. They're the annuitant on it.
Yeah, and you could write that into the trust.
Yep.
Okay, perfect. Thanks. That's one of. Hopefully, this one is.
And how old are you?
How old am I?
Yeah.
I am 64.
Yeah. So odds are you're going to revise this trust before you die. And so the reason I'm stating that, don't let perfection get in the way of progress here, because what often happens, people doing estate planning, it starts getting complicated, and because there's pros and cons to whatever decision you make, right? And then I've seen oftentimes they don't do the estate plan because it just ends up getting complicated, or maybe it causes some conflict in a marriage, and then people put it off. You're 64, odds are you're going to revisit this 2 or 3 more times in your lifetime, if not more.
Okay.
So don't let perfection get in the way of the progress here.
And we do both have wills right now, which passes on in lump sum, and we're just thinking because both of us have that concern, is there some better way to do that? And so I was just trying to determine that. And
it's important. Look, it's super important you've got something set up, because this isn't you have kids from previous marriages. So without this, you die, everything gets transferred to your wife. She dies, it goes to her kids.
with the exception of IRAs, which go to the named beneficiary.
Correct.
Or life insurance.
And
or
people get disinherited.
So what's your second question for us?
Okay, second question is, it's also a follow-up. You guys have said a few times that asset location is more important than asset allocation. And I'm just, if there's any way
as important.
or as important. So could you just, I don't know if you can generically describe that or if you need to hear where everything is or how I have it invested, but I just don't understand my tax implications, I guess, of what I'm doing. Let me start off. My Roth IRA is set up to be all equities, and
perfect.
And the reason I did that was because of the growth, and I don't plan on spending that, and unless my new wife decides to travel around the world 3 times instead of just once.
Okay.
But I do have again bonds in my IRAs, and I don't know if that's the standard IRAs and so forth. So that's my question.
So from a high level, anything that is withdrawn from an IRA, distributed from an IRA or 401k, not a Roth, but traditional, is taxed as ordinary income.
Either while you're living or at your death.
Yeah, taxed as ordinary income. So
to the recipient of that.
So let's say you owned a S&P 500 index fund, then any sort of dividends that they spin off, essentially, because it's in the IRA, it's going to be taxed as ordinary income. And if you own some fixed income, you own treasuries, some other bonds, the interest on those are going to be taxed as ordinary income. Now, if things are held outside of an IRA, let's say in a brokerage account or just held in a direct treasury or something, those qualified dividends from your S&P 500 fund are going to be taxed at a favorable rate because they're called qualified dividends. They get a special tax. It's typically 15%. Could be a little higher if higher income with Obamacare tax. But
and why are they qualified, Scott?
Because that's the way they made the rules.
Just corporation paid taxes on them once already.
Okay, well, that was the argument at the time when they put that into. That's the rules that Congress created for us that we live by. So it's qualified dividends are favorably taxed when they're outside the IRA, and then something like treasuries are not state tax. So if you live in a high tax state, they're exempt from state income taxes. And maybe if you own municipal bonds, for example, you can own municipal bonds. They're completely tax-free. So everything being equal, which is not the case, but all things equal, you would want to have your fixed income inside of a retirement account and your growth equities outside of a retirement account. That's if everything, but everything's not equal. We have our own income needs. We've got a lot of other issues that we deal with.
The second thing is if you've got things that have capital appreciation inside of an IRA, you're going to pay taxes on them at some point in time. But because of the current tax law, the step up in basis, you pay no tax on that.
So if you buy a stock inside of for $10 and it's worth $50 when you die, if it's inside a retirement account, that $50 is all taxable. Your heirs can spread it out over 10 years, but it's all taxable. But if it's held outside, guess what? All that gain is tax-free. So step-up basis.
So sometimes you'll actually see people come in, which will have the stock in their IRA and municipal bonds in a brokerage account, which they're accepting a lower rate of return for tax benefit in it. And it depends on how they're spending the income. If they're not taking any income out of the brokerage, it's completely backwards. You would put your regular bonds inside of an IRA and put all your capital appreciation in a brokerage account.
Because the argument would be you're opting for a lower rate of return on these tax and municipal bonds when it's not necessary because you've got this ticking time bomb of tax from your retirement account.
Yes. And then the second step behind that is you take a look at who's going to receive the money at your death. And so maybe if
there's required minimum distributions and.
Yes.
So
but if the beneficiary is in a much lower tax bracket, then I could make an argument why it should stay in the IRA. But I had a client, and I'm like, okay, tell me about your 4 children that are going to receive this. 3 of them made the same amount of money as dad and mom. So I said, how about the 4th one? It doesn't make as much. So I said, this will be good for 3 out of your 4 children. So that's how asset location works. But it sounds like you're on top of it.
At least you're
Okay.
paying attention to it here. So
Your fixed income is in
yeah.
your IRAs, correct?
Correct. My bond fund is just in my regular IRA. Yes, thank you.
Yeah.
I don't know if I lucked into this. I just knew what I wanted was Roth to be total equity, and so
I
I
agree.
figured I'd just put the bond. And I do have a small brokerage account, but that's minuscule compared to my IRA and Roth IRA. But I do have something in there, and so again, I'm not very good at tax loss harvesting, but I do have some individual stocks in there that I'm looking at that too. So
Well, you
Good.
should. Absolutely.
yeah. Well,
Okay.
glad you called, Glenn, and it sounds like you're doing well, and wish you.
Appreciate the call.
Yeah. And again, don't let the perfection of the estate plan get in the way of just getting something drafted.
Perfection get in the way of progress.
So really, it reminds me, Pat. I had a client. This was a long time ago. Second marriage. Both had kids from previous marriages. Both had their own assets. He had retired and had a pension lump sum that was a significant size IRA, and he had it struck. I don't remember the exact way things were structured, but essentially, he wanted his kids' education to be covered, or his grandkids. I don't remember what it was. Some education costs, and then after that, there was some income off the trust for his wife, his current wife. But then he wanted all the assets eventually to go to his kids. And it wasn't drafted very well. And she essentially spent down his assets over a 15-year period while allowing her estate to grow and grow.
Yes.
And ended up essentially disinheriting. And he had an estate plan in place.
And she was
And I
using the
watched it-
provision for health maintenance and support,
Whatever.
right?
I remember watching this thing.
And
It
you
made
can't
me-
do anything about it.
There's nothing I can
can't?
do about it. No,
Yeah.
I nothing I could do.
Yeah. But that wasn't his intent.
It wasn't his intent, but it was one of those things that you watched happen, and you're like, you need to make sure you've got a.
So he inadvertently disinherited his children.
They got some, but not nearly what. I mean, I think she's still alive, so it's like they haven't got anything yet. But anyway, it's been fun talking about these financial matters, and if this has been of help to you, again, forward it on to somebody, and we would appreciate that. And also, want to let everybody know.
Wait, but
I'm gonna
can
let
you
everybody know.
give us a positive ranking? Are we allowed to ask for a positive ranking? Like when they give you like stars, do you like this podcast?
I don't think so.
We're not allowed to
I
ask.
think we have all kinds of regulatory issues, as most industries do, right? But testimonials are, if something about testimonials, we have to do something else. So
Okay, just give us a ranking.
give us a rating. If you hate the show, then don't give us a rating. How's that? If you think you have the ability to give us a decent rating,
Thank you. Because the algorithm looks at this and will recommend the show to other people.
yeah, and follow
And our
program.
marketing people tell us we're close to the tipping.
Oh, it's going to be here soon.
Soon.
Yeah. Anyway, it's been nice being with you. It's been Scott Hansen, Pat McLean of Allworth's Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.